everyone, and welcome to another episode of Capital Insider. I'm your host, Ellie Perlman, founder and CEO of Blue Lake Capital. And today I want to talk about something that is very interesting to a lot of investors that are trying to figure out which part of the cycle are we in right now. And, I wanted to say that nationally, the clock has just ticked past midnight, supply peaked. It's falling fast. Vacancy is turning over, actually for the first time in 4 years, which is really interesting. But the truth is that there's no single clock. There are 50 plus of them, and half the country is in early recovery. The other half is still working off the biggest supply hangover in the last 40 years. So the edge is really not to know which of the four phases of real estate cycle we're in right now. It's known which clock you're actually standing under, and that's different based on which market you're looking at. So I wanted to start with kind of explaining a little bit about the four phases of real estate cycle. And it always has been, it's the same order, the same cycle. It happens in different markets, are in different parts of the cycle. And the four phases were actually coined by Glenn Mueller. And this is essentially recovery, expansion, hypersupply, and recession in that order. So Dr. Glenn Mueller, he's essentially a real estate economist and a visiting professor at Harvard. He's also a professor at the University of Denver in the business school. And he formalized the four-phase market cycle framework. And essentially, this is a very helpful framework to understand where we are in the market, and whether you are a family office or an investor that invests with other sponsors, or even buying real estate by yourself. It's extremely important to understand in the market that you're buying right now, which of those four parts or four phases of the cycle your market is in right now, because that pretty much dictates everything about the asset performance, pricing, etc. And even financing is impacted by it. So let's kind of double click on those. Recovery essentially is obviously when the market recovers. So in a recovery phase, we'll see occupancy that essentially is starting to climb from the bottom, and you'll see more and more units are being filled. So occupancy is increasing. But basically, in a market that is in a recovery phase, there's not going to be a lot of new supply, if any. And then rents are starting to firm. This is the best risk-adjusted buying, because the market is still licking its wound from the prior part of the cycle, the prior phase, which is recession. And it's hard sometimes for investors to kind of switch their minds and understand we're in a different phase. Those who can read the signals and read the data and are a bit early to buy, like they say, if you heard about the party is over. Those who buy in a recovery stage are those who are going to make the most amount of money. So that's recovery phase. After recovery phase comes the expansion phase. So this is where demand is strong. You have rents that are growing above inflation. And we've seen that essentially pre-2020, where, rents were going crazy. We personally, at Blue Lake, we were pushing rents 30 to 60%, which was insane. Then because of that, the new rents are bringing a lot of developers that are interested in those higher rents, and it underwrites wonderfully at a new construction site. That's why new construction is ramping to meet the demand, because there's a lot of renters that want to rent and are willing to pay higher rents. So obviously new construction is starting, and vacancy is pretty much average, kind of long-term average for multifamily. Now, after expansion comes the hypersupply. This is where construction is just overshoots demand. And that's what we've seen probably in 2020 until 2025 in some markets. So because of the stable vacancy rates, strong demand, really high rent growth, that essentially brings construction to increase demand. So the market is flooded with new deliveries, new units. And that obviously brings vacancy to rise because now you have a lot of competition. It's a little bit of a race it's the beginning of the race to the bottom. Even though the economy still looks solid, sometimes we're in a hyper supply phase where you just have too many units flooding the market. What happens is that the rents are starting to decelerate and then they go negative. And after the hyper supply comes recession. And this is what kind of the last couple of years were, where supply is way ahead of demand. There's just not enough renters for all the new rents. So everyone is racing to the bottom. Everyone is cutting their rates in order to fill up the units and keep a reasonable cash flow. And that what brings rent growth to negative. Then you see a lot of distress. There you see a lot of assets that cannot pay their debt, cannot pay their operational expenses, or they cannot refinance and they have to sell at a loss. Sometimes we see a transaction freeze. So up to 6 months ago in some markets, there were very, very little transactions because everyone who could have held on their assets did so, and only some distress were coming out. Now we see a lot more distressed assets, which is actually really interesting. So I'm recording this, it's mid-August almost. Where multifamily is mid of a little bit past mid 2026, the national market for multifamily is in a hyper supply to recovery handoff. So we're kind of coming out of hyper supply in many markets and we're transitioning into recovery, which, like I said before, presents the best buying opportunity. And that's the single most interesting spot on the clock because this is where the cycle turns. And if you're buying when the cycle turns, that's going to make a great buy. How do I know, or why do I think that? Coming out of MIT and being an attorney in my past life, before I started Blue Lake, I'm very data oriented and I love to see data and I love to let the numbers speak. So I'm not influenced by, the news, the hype, whatever that is, fear or greed. And the numbers are telling a very, very interesting story. And I'm going to add in the show notes, the links and the sources to all the data that I'm reading, that I'm looking at. But essentially, supply pretty much peaked in 2024 and it's fallen off a cliff. But demand from renters is still holding. And that's a very, very interesting story. So when it comes to that, there are essentially a few things that I'm looking at as a real estate investor. And I'm also investing passively with other sponsors outside of multifamily, but specifically for multifamily, there are a few things that I'm looking at. First of all, is completion. And completion is what we call in industry all the delivered units. So these are units that were just finished and they're being delivered and they're hitting the market right now. That's the current pressure indicator because that's what's pushing today's vacancy up and today's rents down. So if we're looking at the numbers, there were almost 700,000 new units that were delivered in 2024. And like I said earlier, that's a almost 40-year high. Then a year later, in 2025, last year, there were about 520 or 30,000 units that were delivered. And this year, we're projected to end the year with 380,000 units delivered. So that's about 30% down year over year. 2027, next year, is projected another 25% lower in terms of completion. So you can see that this is the entail of what started 2 to 4 years ago, because it does take that much, usually 3 to 4 years to complete a building. These are all the buildings that in a project that have started when demand was solid, vacancy was low, that was the expansion, and rents were going up. So that is coming down. And the reason why it's coming down is because there's not addition of new projects because the market shifted and we're in a different phase in the four cycles, like I mentioned before. So completion is one thing to look at. And when you are looking at a deal to purchase, when you're looking at a market, look at the micro location and look at the completion number. That would tell you the story of how how much competition your asset will have to face, and that would directly impact the valuation and the cash flow that the asset is going to generate. Now, when it comes to starts, that's a different metric that I'm looking at. Starts is essentially when the project begins. So this is a leading indicator. So it tells you what's coming up in the next, let's say, 2 years, because now we're breaking ground, and in 2 years we're going to have a completed building, or complex. So Q1 this year, there was about 55,000 units. So that's how many units, new units started in Q1 of this year. 55,000 units is about 73% below the 2022 peak. So you can see that most of the construction, the new starts is basically gone, because now when developers are underwriting, they don't see the returns because rents are not that high. So that's the lowest quarterly pace since 2011. And so that is kind of telling us the story that not only completions numbers are going down, but also starts. Then in addition to completion and starts, we're looking at vacancy as well. And this is where that's the money stat, right? So national vacancy is actually now turning over for the first time in about 4 years. And we see it on our portfolio as well. It's about 7 to 8% in June of this year. And so this is essentially vacancy is starting to go down, which means that now that there's fewer deliveries, and of course it's going to improve because the starts are going down, the new projects are going down, means that there's less competition. And that means that more and more units are going to be filled and vacancy is going to go down even further. That's essentially a very solid, I would say, piece of information that also I'm looking at. And then the last part of it is absorption. And absorption is essentially how many units are being absorbed, being taken by those new units that have been delivered, how many have been taken by renters. So in 2026, in Q1, so this year, 64,000 units have been absorbed. So that's in line with historical first quarter of the norm. So we're kind of going back to norm. All those units that have been flooded the market are being taken by renters. Not much is coming when you're looking at the rear view mirror. Not much is kind of coming towards you. So for 4 years, the story was, hey, there are too many cranes up in the air. But in 2026, the cranes are coming down and renters, they're still showing up. So demand is very strong. So that's not the top of the cycle. We're actually at the bottom of the cycle, and it's turning, we're actually turning into the next phase of the real estate cycle. So I talked a little bit about leading indicators, and it might be a contrarian view, but if you're investing in real estate, one of the best advice I can give you is to stop watching rents, because rents are the last thing that actually moves. And that's after a lot is happening in the background. So what we do and what I advise you to do is to watch what moves first. And there are a few things that move first before rents are moving. By the time rents move, a lot of things have been happening in the market. And it's important to read the tea leaves and understand what's going on. One of them is, like I mentioned before, the construction starts, because that is telling you 18 to 24 months ahead of time where rents will be. And because starts collapsed over 70% from the peak, that's the single most bullish forward signal in the market. Units that don't start today, these are units that are not going to compete with you in 2028. So that's the clearest thing to watch, and it has a direct impact on rents. Now, permits is another thing that I'm also looking at, because that confirms the construction starts. So, and it's kind of the pipeline behind the pipeline, because every construction starts begins with a permit. So construction starts is essentially what's going to happen in the next 18 to 24 months. And prior to that, permits, which can take 6 to 10 months, maybe 12, depending on the market, That is the starting point before construction begins. And we all know that permit, activity has stayed depressed through 2025 and 2026 and probably 2027 unless something drastic is going to happen. So, like I mentioned earlier, the pipeline behind the pipeline is pretty thin. When you're looking at absorptions and deliveries, the moment that on a quarterly basis absorption of new units exceeds the quarterly deliveries in the market, that's when occupancy is starting to heal. And in many markets, they're kind of catching up. Austin, for instance, right now, and I know that has been a market that has been very, very hard to buy, at least for us, because there were a lot of institutions that were competing for deals there. And now it has been in the past several years a race to the bottom. Rents and valuations have gone down. But in Q1 of this year, something really interesting happened in Austin because there were 15,000 units that have been delivered in Q1, but 20,000 have been absorbed. So you had higher absorption than new units. And that's where the Austin market kind of starts, to shift. And it's interesting because Austin was one of the most oversupplied metro in America, also with Phoenix as well. And now the demand to supply ratio is kind of shifting. And that is very, very interesting to watch. And of course, like I mentioned earlier, look at the vacancy direction. Don't really look at vacancy numbers because if we're at 5% vacancy right now, which is considered good for multifamily, but it's rising. That's not a good indicator. If we're at 8%, which is higher than I would personally like to see, but it's falling quarter over quarter, year over year, that's the right indicator. And so by the time rents are going down, or by the time the rents are turning positive, the entry window has already narrowed. And so when you're looking at rent growth, you'll see rent growth after a decrease in construction starts, decrease in permits, absorption to deliveries, it is positive. Like that example with Austin, and vacancy direction is improving. All these signs will tell you that following that, rents will go up. And this is where you want to be. So you want to read the leading indicators before rents are going, because by the time rents are going to go up, there's going to be more capital chasing deals. You're going to be paying higher premium. But if you're patient and you know how to read those signals and can carefully estimate, in the next 12 months, and next 18 months, maybe rents are going to stay flat, but then they're going to increase because of all those leading indicators, then you can make a very, very interesting buy and buy it at the right time. So the way that I'm seeing rent, it's kind of like a rear view mirror, and starts and absorptions, you can think about it as kind of the windshield, right? The problem is that most people drive the market staring at the mirror, looking at rents, but they should be focused on the windshield, on the start and absorptions that are going to tell them the story of what's coming. And that's a very kind of interesting distinction that I see many investors, kind of miss. The national average is actually a lie this year because it's an average of recovering markets with some markets that are still in hyper supply. So there's no one multifamily market right now. So I'm going to give you a little bit of a breakdown based on where kind of some markets are in right now, and that changes. You can find a lot of reports out there that can map which market is in which cycle, which I think is really interesting. But just to kind of put some numbers to attach them to some markets and to phases. There are markets that are still in hyper supply. Rents are still falling year over year and valuations are still suppressed. So you can see, for instance, San Antonio, vacancy is over 15%, which is extremely high, and rents are kind of negative 3 to 4%. Denver rents are still 2.5% negative. Phoenix, about 2% negative. Vegas, 2% negative. So you have some markets like Sarasota and Florida with 17%, vacancy rates. This is essentially markets that are in hyper supply. Now, you also have a different part of, the real estate industry and multifamily that are already in recovery. So, like we said earlier, when you're in recovery, it's the best time to buy. A lot of those are in the Midwest, for instance. So vacancy is much better, 4 to 5%. And you can see the beginning of a rent growth, back to rent growth, which, I think it's really interesting. And of course, even within a market, when I say San Antonio, it really also, there's variations between different pockets in the market. So it's really, really important to double click, and look at it. And I know that the Sun Belt has been the darling child of multifamily in the past, decade or so. And for some investors, that has changed. But even, within the Sun Belt, which I personally believe in and like, the leading indicators are already turning. We've seen an increase in our portfolio in occupancy, and we've seen some rent growth on some of the assets. So, Dallas, for instance, which is a market that I personally like very much, there's a tremendous amount of units that have been absorbed, over 5,000 units. The same, with Phoenix, is almost 6,000 units in Q1. And essentially, yes, Phoenix has suffered from hypersupply, but in Q1 of this year, it absorbed that's essentially 10% of the entire national new deliveries had been absorbed in Phoenix. So that's a very solid indicator that something is turning there. So the Sun Belt is not broken, it's just early in the cycle and it is turning. Some markets within the Sun Belt are over delivered, but now it's turning into overabsorbed, which is exactly where you want to be. So, there's no such thing as the multifamily market in 2026. San Antonio, for instance, is a very different market than Dallas, which is a very different market than Austin. So if you underwrite or look at a deal and you use national rent assumptions, national rent kind of supply numbers, it's just not going to be relevant. You know, you're not underwriting, you're just guessing because you're looking at very, very different, fundamentally different markets that behave, very differently. If you still want to look at kind of national multifamily and where most of or a big portion of the markets are in, then you can see there is some pattern there. But again, you have to kind of double click because you have to remember that in every year, there have been bad deals that have been done in the market and good deals. There have been great exits and bad exits or average exits. So the feeling that everyone is losing money or everyone is making money in a certain year is simply incorrect. And many times investors get the headlines, but it's just not accurate. So if we're looking kind of generally speaking of what happened in multifamily, and again, this is very different from one market to another. In 2015, we had kind of early phases of expansion in the market because rents started growing about 5% nationally. Supply just started kind of to increase and cap rates compressed, and many, many deals actually under panned out and on paper looked great. Now, fast forward 4 years later in 2019, you still have an increase in rents, but it's slower. It's now 3%. That's the late part of the expansion. Real estate was kind of steady, paid full price, and smart money was starting to get more selective. And then in 2021, that's when rent growth really accelerated. Even though we got about 60%, 59, 60% rent growth, the national average in multifamily was 15 to 18%. And some of it was definitely, tenants during COVID that could not go anywhere, could not spend money on experiences and travels and all the other stuff in restaurants because everyone was staying home and they got the stimulus checks. That freed up more, and that's, my assumption, it freed up a lot of their available income and they were able to allocate a bigger portion of it to rent. So we basically had the market flooded with free money, all-time record in terms of absorption of new units. Cap rates were kind of below 4%. There was bidding wars everywhere. We used to lose deals because there were deals that I was competing for 50 to 60 million in purchase price that someone else bid 5 to 7 million more than what I was willing to pay. It was crazy. And that was kind of the last part of the cycle before it turned into, kind of a hyper supply. And so in 2026, which is today, now we're essentially seeing some markets in terms of rent growth. Nationally, the range is between a -1% all the way to almost 1% growth. So you can see some markets there's essentially a very small rent deceleration all the way to some markets are flat and some markets have a slightly positive rent growth. But that's an indicator, like I mentioned earlier, that shows us the hyper supply is bottoming and we're in early recovery. Still, it's very confusing because if you're not digging into the numbers, you're looking at headlines. Headlines are very painful, but when you see that the rents are stabilizing, vacancy is going down, supply is going down, still see a resilient demand. And I've always said that demand is very solid. That's right at the cusp of the next 2015 where all the growth is going to start. So if you're buying in the window now, the next 18 to 24 months, you're more likely to be a winner than a loser. I kind of look at 2026 as the mirror image of 2021. 2021 was max optimism and also max risk. And it was a lot of dry powder, not much dry powder, a lot of money chasing deals. They were, kind of peak pricing, and the supply wave was pretty much ignored because the belief was that there was going to be still strong demand to absorb all those new units, and most investors didn't really believe that the supply is going to impact rents and occupancy. And 2026 is the exact opposite on the other side of the spectrum. It's max pessimism. But this is where when you buy at max pessimism is when you buy at the right price because there's not many that are willing to buy, which means that sellers are willing to receive lower pricing with a very well established, very well run asset in a good market, good paying tenants, and it's just the pessimism that is preventing the seller from getting a higher price, which is great because we're now buying at a discounted basis, sometimes 30 to even 50, 60% discount. So best vintage, best vintages are born in years that feel exactly like this year in 2026, not in years that feel like 2021. It's counterintuitive. If you're excited about real estate, you should not be buying. When the market's pessimistic and hesitant, it's exactly where you need to buy. As long as the fundamentals, of course, are solid, meaning there's still demand for units, rents are stabilized or slightly growing, and occupancy is stable and going up. So, groups that bought in 2021 and underwritten to 2021 rent growth, that could turn into a really challenging asset to manage. And we've seen it, the biggest, most successful real estate managers in the world are handing back the keys. And even if you ran a perfectly well kind of operations and your asset is stable, you're getting, you're collecting rents on time, valuations alone can destroy the value of your asset just based on what's happening in the market. So as sponsors, we have a certain impact on NOI. We can push NOI to some degree. We can, do what we can to raise rents. We can do what we can to cut expenses, but we cannot control cap rates and we cannot control interest rates. And when those are impacting valuations, you can be the best operator in the world, or at least a very good one, and your assets are still going to be underwater in terms of valuation because the market doesn't value those assets in the same way because of everything that has happened in the last few years. So there's a dissonance and kind of a disconnect between assets operations and valuation. So, 2021 felt pretty amazing. That was the most challenging time to buy, in a decade. And it's always, hindsight is always 2020. or sometimes it's 2020. The information that I provided now, and I'm not an investment advisor, this is just my experience as someone who's been buying real estate for almost the past 10 years and was an attorney back in 2027, real estate, and went through that with my clients. This is just what I'm observing. It's interesting how the more sophisticated the investors are, the more actually excited they are about deploying money now, because this year feels pretty lousy, but it's actually the best year to buy. So the clock, the real estate clock doesn't care how you feel. And that's a very important thing to remember. Just separate your emotions, fear, greed, headlines, just read the data. And the data is essentially, going to suggest when you're going to make money. And so if we're going kind of tying it back to the four phases of the cycle, when a cycle is in recovery, you got to buy aggressively. And this is, in some markets are in recovery mode. That's the best basis you can get. Assets that were bought at 300 a unit are now sold at 100, so third of the price. So there's less competition. Occupancy is going to go up in the future, but you're buying today's pain, looking at all the leading indicators, like I mentioned before, with starts and completion, etc., knowing that around the corner things will improve because that's what the data is telling us. This is where you want to be a buyer, and this is where wealth is being created. Now, in expansion mode, in expansion phase, you got to buy selectively because good assets still work, but you're basically, if you're buying at an expansion phase, you're buying for growth that is already visible and is just once the clock shifts and you're going to move from expansion to hyper supply, all this rent growth is going to go away. So you got to be very disciplined when it comes to pricing. Now, if we're moving to the third phase of hyper supply, you have to buy very conservatively and only for the cliff. So if you can underwrite and really zoom in and double click on local delivery schedule and you see where the supply cliff is, where is it behind, then if you can really learn the numbers and see within 3, 5, 10, 15-mile radius how that's going to impact the asset that you're buying and you understand that, that's great. Otherwise, you're kind of caught in a falling knife. And with hyper supply, if you don't understand the numbers and you don't know when it's going to improve, you're going to buy at a very high price for growth that is just not going to be there. Now, in a recessionary phase, that's the fourth phase, like what we have been behaving the last 2 years, got to move on the defense and be patient, focus on distressed assets. You have to preserve capital, be liquid, and wait for the forced sellers, which we see right now. All the fire sales are coming up, and we're able to collect assets, good assets, at a really good price. So in 2026, you want the market where deliveries are brutal right now, and that's what many investors do. So when deliveries are brutal, when you have oversupply, it's crushing today's rents and also sellers' expectations because they know they cannot sell it at such a high price like they could back in 2020, 2021. But you want to be in the market where deliveries are brutal and high, but where starts have already collapsed. So you're buying into today's pain, and you're seeing that in the next 18 to 24 months, there's almost nothing new coming. So you buy the discounted basis today and you own the occupancy recovery tomorrow. And that's essentially the Sunbelt story. That's the value add if I were to summarize it in one sentence. So, if you underwrite to the submarket's actual delivery calendar, that's what you should be doing, not the metro headline, never the national number, obviously. And I do believe that the best entry point in real estate, it always feels bad. If the deal is comfortable, then you're probably paying for someone else's recovery. And I know it's counterintuitive. And, I think that reframing things in those four phases and knowing where your market is at any given time, that's going to give you a lot of wisdom into whether you should be buying. When everyone is buying, you should be very careful because you're buying into a short-term happiness that would turn who knows when. I mean, you can know when you're looking at the starts and permits, etc. But there's going to be a price that you will pay for it. And so being disciplined, looking at the data, ignoring greed, fear, and headlines is the best thing that you can do. That's it for today, everyone. Thank you for listening, and I'll see you on the next episode.